Okay, hi everyone. Thank you so much for joining me today for today's webinar. Probably we'll just wait until 7:01, just for those that are running late to join us. So I will start promptly in 1 minute's time. Okay, so I will kick off the webinar now. So once again, thank you all of you for joining me today. If you tune in to the weekly market scoop, usually I will talk about US indices, of course selected FX and commodities as well. But given that next week we have a guest speaker, I'm sure you are familiar with him. He's called Kwan Hao. He will be sharing his views on the US market. Previously, he has shared his views on Chinese markets as well. So I will leave the indices part of the talks to him. I wouldn't want to interfere with his views. So today is really more of FX and commodities, some of our views on where things are headed. And no doubt, recently it has all been about tariffs. So market is very reactive. It is very headlines driven. So if you do not follow the headlines closely, you may be caught in some of the market swing. So within 5 minutes, things can swing very wildly. I think we have seen that today as well. If you look at the chart, if you zoom in to the 5 minute chart at 4:25, suddenly market reverse to the upside. Of course, it's still in the loss, but futures pair quite a bit of the losses. And then, people will be scrambling and asking why. And if you look at the headlines, it's because of, some speculations of China being inclined to talking with the US. So markets now is very headlines driven. It can be hard to trade because, you do not know what will the next headlines be. And Trump is known to be very unpredictable. I mean, if you know what he's thinking, please share with me because I really do not know what he's thinking next. He does floated some tariff on semiconductors, pharmaceuticals, but he also floated exemption. And we know that some of the countries are actually engaging in trade talks with him. So things are still very uncertain. But if you ask me for my broad views on indices, I believe that the risk of it being a bear market rally is still here. If you look at the market structure, we haven't exit from the lower high, lower low kind of a market structure, which means that the trend is still leaning on the downside. What I expect is that we may have some optimism in April. I mean, as talks were ongoing, we may hear some of the trade deals around, particularly from Japan, from UK, South Korea, so on and so forth. But eventually, once we reach May, that is where the weak seasonality tends to kick in. So usually the seasonality for May, for September tends to be weak. So if market wants to squeeze out additional gains, now is the time to sort of do so. And there are catalysts in terms of some tariff exemption, some trade talks for trade deals ongoing, and recently some inclination that China is open to talks. So if markets wants to squeeze out additional gains, this is the time to do so. But I believe that it will still be a bear market rally, looking at the market structure. Okay, but that aside, next week I'll leave it to Kwan Hao. He may have a different view, but this is just my personal one. So do tune in next week to his webinar. He will be talking about the US market, which may be of interest to many of you. For today, I'll just touch on FX and commodities. Before that, just some advertisement on my part. I see a lot of familiar names. I wouldn't want to, go through some of the details about IG. Basically, we are a trading company. We are number one CFD and FX broker. as of some of the data from 2022 and 2023. Promotion that we have ongoing, we actually have this promotion whereby if you are a new client, you open an account, you trade CFD with us, you actually stand to gain cash of $2,088. But of course, there are some criteria which I believe is relatively easy to fulfill. Number one, you open a new account. Number two, you deposit at least 1,000 into your account through a variety of payment methods, and then you start trading. And based on the notional value that you trade, it will determine how much of a welcome bonus you will be entitled to. Do feel free to scan the QR code at the bottom left-hand side of the corner. But otherwise, if you look at the criteria, if you trade around 10 million notional value, which can be relatively easy to attain if you trade FX, you'll be entitled to $2,088 welcome bonus. So this is the ongoing promotion that we have. Do take advantage of this promotion while it lasts. And if you have any question, do feel free to call our hotline and inquire more. Okay, and diving into the content, just want to put the disclaimer out there. So do take note that today's presentation is purely for educational purposes only. It's purely my views. It doesn't represent anybody else. It doesn't represent the company. So if you are engaging in your own trading or investment journey, please do your own due diligence. Okay, this is me. I'll just skip it. Okay, very volatile world. I think recently, if you follow the headlines, Singapore is going to have an election upcoming 3rd of May. Very exciting. And a lot of leaders have come out and talk about, U.S. Tariff on the world, U.S. tariff on China. And one of the key takeaway, if you follow some of the speeches from Lawrence Wong, from Lee Hsien Loong, the key takeaway is that we are looking at a paradigm shift in terms of the trade world. And if you were to track the news, I think I'm having a difficult time tracking the news as well, because every few days there's new tariff ongoing. There's a lot of flip-flop. So one moment, the US can implement tariff on some countries like Mexico and Canada. Next moment, things could be delayed. So I think this is the key points around tariff that I have managed to consolidate. Some of the things that we have in place, ignoring all the noises, what we have in place is a global 25% tariff on steel and aluminium. And China clearly is the least favorite in US eyes. I think China has been singled out as this sort of a bad partner, whereby they are the only one that implemented retaliatory tariff immediately, and therefore US is coming kind of hard on them. For now, it's 145%, but if you look at the latest news, I think some of the products can get up to more than 200%. I believe when US have this duty on Beijing of 145%, it really crushed many of the export demand. And China, on the other hand, has also raised its total counter tariff on US imports to 125%. So basically what they are trying to do is they are sort of decoupling from each other. They are saying that China is saying that if there's no US demand, we will take the hit, fine, but we are going to expand and diversify our trade relations across other trading partners. So you see, President Xi lately has been going country to country. He has gone to Vietnam. Some of the tone there seems, calling each other brother in terms of trade. I think he's trying to form new trade relations with, Vietnam. Now he's in Malaysia. Most likely he will clinch some form of a deal there as well. So all of these, I believe, will help to cushion the impact of a US tariff on Chinese exports. Because we have to understand that Chinese economy is still very export driven, even though they are trying to shift towards consumer economy. They are trying to shift towards more investment. But that will take time. For now, exports still accounts for a significant portion of China's growth. And out of all the Chinese exports, 15% is from the US. So US, a single country, account for 15% of Chinese exports demand. So that is why when US were to pull out totally with all of these tariffs, it means that China can potentially lose up to 15% of its total export. So President Xi is really struggling trying to fill that gap, or rather trying to cushion that kind of a 15% impact. But it will be tough because US consumers is a very good stronghold. US consumers is one of the best, if not the best in the world. They have high income, they have low savings rate, which means they are very inclined to spend. So when Chinese, Xi Jinping went to Vietnam, Malaysia, try to get some form of a trade deal there, fine, it can help to cushion, but it won't fill the gap totally. Because Asian countries, usually our savings rate are higher. We are known to be more prudent in terms of our spending. Our income is relatively lower as well compared to the US. So US consumer is still this very strong base. But with all of this tit for tat, no doubt, China is in this scramble to really try to find some of the demand from across the region to try to fill this gap. But it won't be easy, like I said, so we may expect some of the economic data to slow down over the coming months. So the challenge is whether China can really avoid that kind of a recessionary playout. Okay, so back to this tariff. Now we have 25% on steel, aluminium. Chinese 145. Today's news, potentially more than 200%. We also have this 25% tariff on imported cars, automobiles, that is in effect. We have 25% tariff on some Mexican and Canadian imports that is in effect. We have the baseline 10% tariff on all imports from all countries that is in effect. Some of the other reciprocal tariff we know are paused for 90 days for trade negotiation to take place. But upcoming, we also have some product-specific tariff. So Trump is moving towards targeting some of the key areas like semiconductors, technology, pharmaceuticals. Previously, he has floated on copper, lumber. Those are the areas where we still need more clarity in that sense. So this is the timetable of tariff that we have. As you can see, it's very dynamic. And what I believe is that while recently there has been some cheers around tariff rollback, we still got to take note that there are still existing tariffs in place which are quite hefty. 25% steel, aluminium, 25% on automobiles, baseline 10% tariff. Those will have an impact on global economy. So it's still too early to cheer. But of course, for now, we have seen the initial wave of panic kind of subsided. Markets are trying to stabilize. But I believe this will not be the end. I believe that few months down the road, some of those tariff impact will be reflected in upcoming data. And even now, we have seen if you track the US Consumer Sentiment Index last Friday, things have started to show up already. Consumer sentiments hitting a multi-month low, inflation expectation rising as well. So we are seeing some early signs of the impact that tariff have. And now we should expect more damage to surface over the coming months. So that will be something that markets will have to digest and struggle with. Therefore, I believe that, probably we have not seen the worst yet. So while markets have room to squeeze out additional gains, I think heading into May, things may get a little bit more cautious. So if you look at some of the FX pair, very interesting. There are three pairs that stand out very, very nicely. One is the Swiss franc. All of these are relative to the US dollar. So you see the Swiss franc pulling ahead, Japanese yen pulling ahead, euro pulling ahead as well. No price for guessing why Japanese yen and Swiss franc are pulling ahead when markets turns risk off. This safe haven currency has been gaining a lot of traction. For euro, it's quite interesting. I think there are some views that, of course, with some of the increased fiscal spending coming from Germany, that may help to cushion some of the tariff impact. And of course, there are also the views that if China were to decouple from the US in terms of trade, that means Chinese trade activities with Eurozone may increase, and that could also help to cushion some of the impact. So China is actually Eurozone's one of the key trading partners. So all in all, there's this view that things may hold up relatively well for the Eurozone, and therefore, the euro dollar seems to be holding up strong. Apart from that, some of the currencies like Kiwi, Aussie, Pound, they are still squeezing out positive gains year to date, largely thanks to this weakened US dollar. But the gains is of course are not as strong as the safe haven pairs and the euro currency. In terms of Asia, good thing we have the Sing dollars kind of outperforming. So across Asia, I think Sing dollars is viewed relatively as a safe haven, given our political stability, our neutral stance, so on and so forth. So Sing dollars have been pulling ahead. Korean won, I think some of the abating of political risk with their presidency has probably helped to drive some traction on that end. On the other hand, Indonesia rupiah is the underperformer. I think it is the only one of the two in a negative territory year to date. The other one is Taiwan dollar. But Indonesia rupiah clearly underperforming. I think with their new leadership, a lot of question or doubt over some of their policies. And therefore, it caused a lot of capital outflows from Indonesia among foreign investors. So that could contribute to that hit to the Indonesian rupiah. Okay, so all of this is in relative to the US dollar. So all the currencies have been taking its cue from the US dollar. So the question is where could be next for the US dollar? If you just look at the Fed rate expectations, when I look at it, it does feel that markets are actually projecting that growth conditions will worsen dramatically over the next few months. If you look at the Fed rate expectations, we are actually looking at back-to-back rate cuts. Of course, in May, rates should stay the same. But if you look at this table, what markets are pricing at the moment is that June, there will be a 25 basis point cut. July, another 25 basis point. September, potentially another one. And then December, another one. So we are looking at back-to-back 4 consecutive cuts in the second half, nearing the second half of this year. So to me, this is quite aggressive. And we know that that will warrant economic conditions to worsen dramatically to show recession risk so that the Fed will embark on these back-to-back cuts. And that's quite worrying. That's quite worrying to me. And one of the key indicators that we should look out for is the unemployment rate. So now we have the US unemployment rate at 4.2%. If you look at the Fed's March projection, they are projecting by end 2025 is at 4.4%. So we are just 0.2% away. And if over the coming months we were to see an overshoot of unemployment rate above 4.4%, that will prompt the Fed to act more aggressively, which should fulfill these market expectations for these back-to-back cuts. So I would say that we are not out of the woods yet. We are still expecting some form of a slowdown, some form of a more aggressive reaction from the Fed moving forward. And if those are confirmed, if unemployment rate were to really overshoot above that 4.4%, that is going to weigh on the US dollar. Of course, some of the views around US dollar is that some foreign investors could be selling their treasury, they could be exiting the US economy. So what they do, they sell their treasuries. With that US dollar, they actually convert to their domestic currency. So that means they sell US dollar in order to prop up some of their currencies, some of their domestic currencies, to avoid excessive capital outflows, or to support some of the trade, to ensure some form of a currency stability on those economies. So those are more prominent in terms of emerging economies, like I say. So I think China recently selling treasuries. Some views are that they may be targeting the US, but to me, I believe probably not. They could be offloading some of their treasuries so that they have that US dollar to offload so as to support their currency. And that could be one of the reasons why we are seeing bond yields still high in the US, and US dollar actually weakened. So there's this detached of relationship. So I think the explanation may work to explain why there's this detachment, whereby selling of treasuries and also the selling of the US dollar in that sense. But of course, the real reason we will not know. But as of now, it does seem that US dollar is under a lot of pressure. And they are not wearing the safe haven cap right now. So 2018, we still see some strength in the US dollar. And but second term for Trump presidency, we are not looking at similar strength. So the trend has actually diverged. And in terms of some of the tariff reprieve headlines, it has also failed to uplift the US dollar. So the previous argument is that when markets are pricing for a dovish Fed, markets are pricing for recession fears, that weigh on the US dollar, fine. But now we are getting some of the tariff reprieve headlines where we have this rollback. But the US dollar hasn't been surging or sort of regaining their strength in that sense. So to me, I believe that we could be looking at a wider capital outflows from the US, like I share, where foreign investors, given that political uncertainty with US President Trump, they are actually sort of divesting their US assets. It could be real estate, it could be treasury holdings, it could be investment. They are actually divesting their US assets, sort of pulling out from US in that sense. So we could be looking at a more structural trade decoupling amid this geopolitical uncertainty. And that could explain why the US dollar has been very weak, despite despite us being past this panic stage around tariff. So even with now trade talks with some of the rollback in tariff, the US dollar didn't really recover in that sense. So to me, that could explain why, because we could be looking at a more structural shift in terms of foreign investors divestment in that sense. If you look at some of the, that's the US 10-year yields, of course, it remains high, and the US dollar has weakened to its multi-month low. Likewise, the explanation could be, offloading of treasuries and converting, some of those US dollar back to domestic currencies in that sense. Capital outflows is the key takeaway here. So this is just my view to explain why, treasury yields remain high while US dollar actually fall. So if you look at some of the technical side of things, of course, we are looking at a breakdown of that key psychological 100 level for US dollar. You have seen all of these headlines around the news outlet. When you break past 100, everyone starts to worry what's next. Near term wise, I think the downward pressure could continue. I don't think we are looking at a low yet. That recent break to a new lower low, break past that recent consolidation zone, it does suggest that bearish pressure seems set to extend further. But of course, if we zoom out to the monthly chart, which I presented here, one hope for buyers could potentially be around that circled level right there, because since 2008 financial crisis, the US dollar has been recovering quite well. I will say that technically wise, we are looking at a rising channel, and if the US dollar wants to find room for support, the lower channel trend line could potentially be one to defend. And I believe that at this level, things could be more attractive from a risk-reward ratio point of view as well. Where of course, if you were to break down below that channel trend line, that is where you will acknowledge that this hypothesis could be wrong. But as of now, I do see this upward channel, this longer term monthly chart upward channel in place. But that also means that there are still room for US dollar to sort of weaken further over the coming months. If you look at the weekly chart, okay, the weekly chart, what I'm seeing here is of course that 200-week moving average. Why is this so? Of course, when back in 2022, if you see that black arrow there, 2022, things sort of move above that 200-week moving average, found support there, and it bounced off. And more recently in August 2024, the US dollar hit back to that 200-week moving average as well, found some support. Thereafter, it bounced off again. So now we have broken down below this 200-week moving average. While there could be room for some form of a unwinding, I believe that will pose as a resistance, which could bring another leg lower towards that longer term trend line that I mentioned here, which it could be around that 96.2 kind of a level. Until we are able to move above that 200-week moving average, I believe the bearish bias should continue. So this is for the US dollar. So what does it actually mean for some of the other major currency pair? One I see more commonly traded one is the no doubt the euro dollar. And if you look at the rate expectations, so we know the US Fed is expected to cut 4 successive rate cuts by the end of this year. For the European Central Bank, it does seem that market are expecting them to cut by less. So April, which this week, tomorrow in fact, they are expected to cut by 25 basis points, but they are actually inching nearer and nearer to the end, which is the potential neutral rate at around 1.75%. So that means that by September this year, they should guided that their rate cuts process should be mostly done, and they are more happy to keep rates on hold. So I think they have room to actually sort of a lean slightly more hawkish further down the line into the second half of this year, which seems to contrast a little bit with the Fed, which will still continue on its back-to-back kind of rate cut process. So the takeaway here is that ECB may cut at a more gradual pace, and of course what this means is that the euro dollar may have room to squeeze out further gains. And if you look at some of the economic data between the Eurozone and the US economic conditions, this is the differential between their economic surprise index. How you read this is that, the positive economic surprises for Eurozone has actually been far higher than what we see in the US economic surprises. And this means that, if you were to split this chart, this means that for Eurozone, economic conditions are actually surprising on the upside. Whereas on the other hand, US economic surprise-wise, US is actually surprising by less, or in fact, it could actually be coming in weaker than what market expect. So in that sense, of course, it does suggest that there are sort of more confidence, more room, for investors' confidence around Eurozone's growth conditions to improve moving forward, given all of these upside economic surprises. Of course, we also have increased fiscal spending from Eurozone to cushion a tariff impact. Of course, the exposure to China remains on watch, because if US were to hit China and China's economy were to slow, the general convention is that the demand from China for Eurozone could also slow as well. But of course, if we take on another sort of thinking cap, like I mentioned, if China were to decouple from US, China will actually improve the trade activities with other key trading partners, and that includes Eurozone. So Eurozone could be this region to absorb some of the trade shift from US, given that Eurozone, they also have these demographics of having relatively higher income and lower savings rate as compared to Asian economy. So if China wants to find a consumer base to replace the US, that means that they will continue to work with Eurozone in terms of trade, and that should help to support or cushion some of the Eurozone's economy in that sense. So it does seems to point towards some support for the euro dollar as well. Of course, if you look at the euro dollar, things have already surged out of hand. If you just look at the recent market structure, if you are familiar with bullish flag formation, we have that bullish flag in place, we have that bullish flag breakout. Now we are close to that flag projection target around 1.148 level. Of course, if you are worried about near-term things being overbought, that is a valid concern. I would rather wait for a potential pullback in that sense, where technical conditions may be more neutral. That could mean waiting for maybe your RSI to revert back to the midline, your MACD to really roll over in some sense, or your DMI to really hit back to that 25 level. That will suggest that technical conditions are more neutral. And if you want to ride on the trend, those could be signs for you to sort of jump in this long euro dollar trade. So some of the immediate support, of course, I see is around the 1.119 or 1.20 level, where I believe there's a 38.2% FIBO level in place. So any form of pullback that should offer some of the more attractive risk-reward dynamics. If you look at the, I think this should be, sorry, this isn't the daily chart. I got to change the header. This is more of the monthly chart. Because some of the question is, yes, I mean, if you are looking at upside in the euro dollar, where is the point to watch out for? If you zoom out, you will see that since 2015, or rather since 2008, the euro dollar still continue on this broader downward trend. Downward trend meaning the market structure seems to be pointing to the formation of lower high and lower low. We aren't out of that yet. Even if you look at the recent channel that I've drawn here, we are still forming lower high and lower low. And therefore, of course, if things were to head up further towards that upper channel resistance, I may expect resistance to kick in. And that is something that we got to be very mindful of, be very careful in that sense. Okay, next up, if you look at the dollar yen, generally, I think the Bank of Japan still seems to be very different from the rest of the world. This is the market expectation. So basically, they have hike rates at the start of this year by 25 basis point to 0.5%. I think given all of that uncertainty, markets are expecting them to keep rates on hold through the rest of this year. And of course, they have this caveat that the Bank of Japan mentioned that they're going for this data-driven approach, which means that future rate decision will still depend on economic and price development. To us, our view is that there's still the risk that the Bank of Japan may be forced to hike rates. For now, they are taking more of a wait-and-see approach, given all of that tariff uncertainty. But we still see room where they may be forced to sort of act or to lean more in keeping inflationary pressure down. Why is this so? Because if you look at some of the economic data around Japan's inflation, if you look at the chart on the left, the gray line is the 2% Bank of Japan target. We have been above that target for quite some time, 2 years plus, in fact. And the Bank of Japan policymakers always say that they want to have more conviction around wage growth to be more reassured that some of those inflation are demand driven. And if you look at the monthly cash earnings, it has also been trending higher. If you just look at the chart on the right. So it does seem that the boxes have been checked in terms of inflationary pressure, in terms of demand-driven wage pressure in place. So the boxes have been ticked for them to move forward with additional form of a rate hikes. It's just that things are being put on hold at the moment because of the US tariff. So we still see, potentially room for additional tightening to take place once some of those tariffs were to present a greater form of clarity in that sense. And what this means, of course, is if we look at the US-Japan 10-year bond yield differentials, which tends to lead the dollar-yen form of a trend. We can see that what I'm seeing here is that there is this lower high, lower low kind of structure in place, which means that the US-Japan bond yield differentials could be narrowing. And what this means is that it should lead the dollar-yen kind of a lower, given the relationship that this currency tends to have with this bond yield differential in that sense. Okay, if you look at the dollar yen, to me, I believe there is this risk. There is this risk that we could be looking at a downward trend for the dollar yen. My thesis here is that if you look at from maybe from 2021, we have this higher high, higher low kind of a structure where things are pushing on higher high, higher low. But lately, if you look at early 2025, that is that first lower high sort of being formed compared to the previous peak. And if you zoom back towards August 2024 in that sense, we can argue that we have actually formed a lower low. So we have that lower low, now we have that lower high. The risk now I see is that we could hit below that August 2024 low, and that will confirm another new lower low in that sense. And that will sort of, reiterate all of this view that the dollar yen trend is moving to the bearish end. So this is what I see. So still kind of a dangerous, I believe. We could be looking at a broader trend shift to the downside for the dollar yen. Okay, last but not least, I think many of us, we trade the pound. So I will just go through this very, very quickly for the interest of time. In terms of the Bank of England, I think they are in a better footing, I would say, because that if you look at the UK, that is actually one of the country where the tone from the US seems very positive. So when we look at Japan, which is US allies, US, their relationship has always been very close. But if you look at the recent tone, Trump isn't afraid to shoot down Japan and say that, they have been extorting us. We're going to have this 25% tariff on their imported cars in that sense. But if you look at the UK and US dynamics, it does seems, they're a little bit more like a brother in that sense. If you look at the recent tone from a US Vice President, the tone is that, there's this good chance of a trade deal. Trump really loves Britain. So I think most likely they will be the one of the first to secure a trade deal. And we know that the reciprocal tariff on UK is at 10%, which is the minimum baseline. So they are sort of spared from that higher tariff in the lights of what we've seen in the, many other Asian countries. And easing inflation for March, that may lay the groundwork for another 25 basis point rate cut in May. But similar to the Eurozone, what markets are expecting is that it will be, by the end of this year or by September, we should head into this neutral rate for the UK, which means that the central bank will start to guide for a rate pause. That will be a hawkish stance, and that should uplift the pound in that sense. So in a way, the pace of rate cuts may continue, but it will take place at a more gradual pace than what we see in the US. And if you look at some of the growth, once again, I look at the economic surprise index. If you look at the UK, things have been holding up relatively well, whereby economic data has been coming in much better than what markets are expecting. I didn't show the index here, but you can Google it, and you'll see that the economic surprise index for the UK is at its highest since August 2024. And this is the growth projection that I pulled out from Reuters, Refinitiv. It does seem that the UK is expected to undergo a stronger growth in 2025 and into 2026. And I think it's quite a, of course, this is just a projection from economists, but if you take it as it is, you can see that UK growth is expected to improve. And this comes at a time where US growth, which is just above the UK under this table, this comes at a time where US growth are expected to slow, and expected to slow quite drastically, I would say. 2025, we are looking at 2.2%, which comes, from a huge base at 2.8% in 2024. So I think this divergence in terms of economic growth could be something to watch out for, because what it does means is that the pound dollar may have more room to improve given this difference in the economics growth dynamics. If you look at the weekly chart, once again, I think we are looking at a good channel pattern here. This is the weekly chart. Likewise, the arrow here I actually pointed to. If you are familiar with this single candlestick pattern, is actually a bearish shooting star. But what we are seeing now is that even with that bearish shooting star, the retracement is short-lived. And now we are actually heading above, which means that some of those shorts should start to, or rather will be squeezed out in that sense, and buyers are really in strong control. So I think going by this trend, buying on weakness is still the preferred approach. And what this means, if we follow this channel pattern, is we could head closer towards the 1.351 or 1.352 level, and then the resistance will start to kick in. Okay, in terms of US dollar to the Chinese yuan, I think there are some traction here lately, given that simmering trade tensions between US and China. And what we are leaning into is that we could be looking at a gradual weakening of the Chinese yuan just to ensure some of the currency stability, and also to a weaker yuan could be one of the weapons being used to weather against US tariff. So we should expect a more gradual weakening in the Chinese yuan versus the US dollar in that sense. If you look at some of the economic conditions for China, I think generally things are holding up better. If you look at some of the economic data today we have that retail sales, industrial production, we have that GDP, which really surprised on the upside, but markets are saying like, these are backwards looking data. It doesn't factor in the tariff impact. So markets are expecting downside risk to growth to show up ahead, which means that stimulus measure may pick up, policymakers may turn to further rate cuts that may sort of weaken the Chinese currencies moving forward. So this is the weekly chart for the US dollar to Chinese yuan, offshore Chinese yuan. Previously, there was a break above that horizontal resistance, which I thought was really kind of a remarkable feat. Now we are back down again, but you can see that buyers are not giving up. We are actually potentially moving back to retest that horizontal resistance. So I would say that if you are able to see a close, above that 737 level, I think it should confirm sort of a breakdown of that this wide range, and that should set the stage for sort of a more upside to come. Okay, so that's the end of the currency side of things. Now I'll just quickly move on to the commodity side. Some of the more commonly traded one, such as gold. I've written a short piece today on gold prices. So basically, these are some of the factors that I believe could be influencing gold prices. Of course, one is the US dollar weakness, that US tariff fear, that geopolitical premium being priced by markets, central bank rate cutting cycle, central bank demand. We are also seeing some slight picked up in terms of ETF gold buying. Of course, some of the risks to watch is that US 10-year real yield. So these are the factors that are propelling gold prices today, or rather over the past few months. You can see that the chart on the left still says that central bank continue to buy more than what they sell. So this trend has continued, and if you look at January, things seems to be picking up further. And if you read some of the headlines, I think all the way till March, they are still loading up on gold, particularly in terms of emerging market central bank. And if you look at the chart on the right, that's the economic policy uncertainty index. Things are still very uncertain. It's still at this sort of multi-year high, and that means that there's still this preference for gold as a potential hedge against portfolio volatility. If you look at some of the other trends, ETF holdings, so we are seeing increased interest in terms of gold ETF, where if you look at this gold trust, this SPDR gold trust, which is the largest gold ETF, things are picking up. Means there are actually increased interest from the retail sides or institutional side in terms of buying into this ETF, and that has helped to support gold prices. And what I see is that if you look at the holdings level, we are still far off the extreme. We are still far off the extreme seen in 2022. We are still far off the extreme seen in 2021. And that means that there could be more room for interest to improve further in terms of ETF, and that should support demand for gold in that sense. On the other hand, the chart on the right says that global central banks are divesting or diversifying their reserve away from US debt and into gold. So you can see that since 2020 or all the way since 2015, the central bank has been trying to diversify but of course the trend lately has been accelerating given the uncertain trade dynamics that we have. If we just look at this, right, currently the percentage for gold being held in central bank reserve assets is at around 12.5%. What I read of this is that many emerging countries are trying to diversify, but if they will really want to catch up with the advanced economies such as Eurozone, which has 28% of their reserve in gold, currently 12.5%, it seems that there could be room for additional demand to kick in, which means that the central bank purchasers could have further room to run, and we should see continued net purchases of gold from central banks moving forward. But of course, where are the risks? Risk-wise, 10-year real yields sort of remaining high and doesn't seem to be heading down. And on the other hand, if you look at the Bank of America Global Fund Manager Survey, long gold is actually the most crowded trade. And what that means is that we could be due for a retracement. Because if you look at this Global Fund Manager Survey, a few months back, things are pointing to the long Magnificent Seven as the most crowded trade. And we do not have to say, you know, just what happened over the past few months where there's this unwinding in terms of Magnificent Seven. So now long gold is the most crowded trade. And of course, while the fundamentals still support gold prices, it does seem that at current levels, things could be a little bit shaky, because if you're to jump in now, you are, you know, sort of being late in that sense as compared to many investors who are already in the game. So something to really take note of. And therefore, I believe that while the broader outward trend should remain in place, I would want to see sort of a retracement and potential buying on dips in that sense, because I think the current levels may seem to call for some cool off. If you look at the weekly chart, I'm looking at that. If you look at that dotted line on the RSI, I've drawn this dotted line where, you know, the weekly RSI, every time it hits somewhat of an extreme, there's somewhat of a retracement. We have seen that in 2024. We have seen that in the August 2024 as well. And now we are heading towards that sort of extreme weekly RSI level. So there's the risk of potential bearish divergence on the weekly chart. And what that means is that, you know, we could be due for some retracement, but of course the broader trend should remain upward bias, because if you look at 2024, around that April period, there was a retracement, but you know, it sets the stage for another leg higher. Likewise, in August, when the weekly RSI hits such extreme, there was also a retracement. And thereafter, it forms, you know, it continued on with another leg higher. So now we are around that extreme weekly RSI zone. I'm getting a little bit uncomfortable with longing gold at this level. So I hope to see some form of a move, potentially back into that neutral zone before, you know, sort of considering buying on weakness. So that is just my views if you are looking at gold in that sense. For silver prices, so there's this general convention that silver prices tends to track gold. They are both precious metal. But of course, I think catching up to gold, that seems to be a different dynamics altogether. Because we have to understand that when you talk about safe haven, people will still think about gold. You know, they wouldn't really think so much about silver, because silver-wise is still having some relationship to industrial demand. So silver is actually being used in a lot of industrial goods in that sense. So it is a material input. And compared to gold, central banks, when they diversify, they will want to diversify more towards gold. That is the universal sort of a more well-recognized sort of a diversification from the US dollar as compared to silver. So even though there is this general convention that silver and gold may move hand in hand, if you look at this chart, things seems to be very different. Where gold has been hitting multiple record highs, but silver hasn't been displaying that trend just yet. And this is the weekly chart. What I'm looking at is that potentially things are still uncertain on whether silver can sort of reach a new high. And my view is this. If you look at some of the labeling of this chart, so 2024 onwards, we have managed to break through multiple higher highs, higher lows. And but recently, in 2025, same thing, we have actually formed a lower high. If you look at the font, the label that I've put down in red, which means that we didn't manage to reclaim, or we didn't manage to move past the previous high. So we have this formation of lower high, and more lately we have punched through below the December 2024 low, which means that we have a new lower low. So whether this marks a potential trend shift to the downside, I think the risk is there. So unless we are able to sort of reclaim sort of back above that $34 level, otherwise, I'm still slightly more cautious around silver prices. Last but not least, I think oil prices. I think these are some of the catalysts that are in place. I think the general takeaway is that the headwinds for oil prices seems to far exceed the tailwinds. So if you look at the headwinds just today, the International Energy Agency from US, they came out with a statement, global oil demand expected to grow at its slowest rate for 5 years. And we do see upside risk to China's growth outlook. So while we expect stimulus measures to kick in the later half of this year, we believe any policy response will be reactive in the light of what we've seen last year in September, where, nearing towards the end of the year, where the Chinese authorities saw that their 5% growth target is getting harder to achieve, then they unleash those kind of a hefty stimulus to sort of stimulate growth and to meet their target. So I think they are more reactive in that sense, where we have to see a sharp weakening in terms of economic conditions, and then they will step in thereafter. And what this means is that those economic data could potentially weigh on sentiments, and that may suggest short-term weakness before some potential stabilization. Some of the headwinds on the supply side, we know the OPEC Plus have begun unwinding their previous voluntary cut. Starting in April, that means more return of oil supply to the market. We have the Ukraine-Russia conflict. I think US President Donald Trump has been very firm in trying to end the war. And in talking to Russia, I'm sure that one of the criteria to reach a peace deal is for Russia to really bring out this proposal for this formal reintroduction of a Russian oil into the global market, because that is one of their key source of revenue, and that has been being placed on sanctions in previous years. So to end this war, this could be one of the criteria being floated. And if we really go through with it, if the US is okay with it, what that means is that we may be looking at an influx of Russian oil back into the global market. Of course, on the other hand, the slight tailwind, I would say, is that the sanctions on Iran, which is another key oil exporter, the sanctions on Iran could pick up the pace. I think the tone from the US on Iran hasn't been very nice. So they should have more sanctions on Iran oil exports. But if you look at the totality of all of these factors, in a way, it does seem that the headwinds could potentially outweigh, the tailwinds moving forward. And it's really hard to go against President Donald Trump's aim. So he wants to bring down inflation, and how he see it is that to bring down inflation, the most clear-cut way is to bring down oil prices. So he wouldn't want oil prices to remain high and serve as this price pressure on US consumers. So any form of a upside or surge in oil prices, we may expect some reaction from the US, potentially pressuring the OPEC to raise oil supply, or even the US itself potentially raising oil production in that sense. So I think if you look at the daily chart, we have a slight bounce, but the broader trend still points to the downside for sure. So with this recent bounce, it could be a temporary one. It could set the stage for potentially another leg lower. If you look at the weekly chart, so all along it has been holding up above that $70 level. This is for Brent crude. So that recent breakdown does give a signal that buyers cannot hold the line anymore. So we are looking at a new lower low, which means a bearish trend in place. And what this means is that the strategy here will continue to be to sell on tops and to sort of potentially fade any form of a upward bounce in that sense. Okay, last one, I swear, I know I've overrun already. But last one in terms of copper prices. Very interesting. Copper prices wise, I think if you look at this weekly chart, the broader upward trend still seems to remain intact. Higher high, higher lows. Recently, we have managed to push on with another higher low despite that recent sell-off. So, riding with the trend could really means buying on dips. With the bets that this upward channel could potentially stand in place. Okay, so with that, thank you so much for tuning in. Before you go, probably I just want you to just do me a little favor. This is the feedback form. So we actually need this. I need this form to account to my boss on the feedback from this webinar. So do me a quick favor. Scan this QR code. Input your feedback. Input what you want to hear in upcoming webinars. Input some of the key takeaways that you like or something that you don't like, so that we can also improve and provide better content for you for future webinars. So I appeal to you, do this survey for me. I got to bring this up to my boss. In the meantime, while you are doing the survey, let me just take a look at some of the questions. Let me see. Oh, there's quite a lot of questions. I'll try to see, because I'm running short of time here. Okay, some of the admin questions. Are you making weekly market review? Yes, I think the weekly market scoop that focus more on indices, because that's what your trade, right? I think the weekly market scoop that focuses on the indices, so on and so forth, should continue. It's just today is special. Today is a special webinar on FX and commodities, because Kwan Hao will be stepping into next week to share his views on US market. So do tune in to his webinar next week. He is a very well-versed, he used to be advisor for hedge fund managers. So definitely something that you can take away from him. So do tune in next week to his webinar. But thereafter, my weekly webinar should continue. Okay, how bad will it affect US if China restrict or ban export of rare earth to US? Yes, very interesting question. So I think we are seeing the China adopting some of the geographical strategic advantage that it has, which is that it has some of the rare earth export. So by restricting it, some of those rare earths are being used in key technologies such as your semiconductors, your chips, and therefore by restricting, it can be a statement or it can be a retaliation against US in that sense. But we are also seeing that US acknowledge this problem. And if you were to recall, I think they are actually pressuring Ukraine into a rare earth deal. And some of those rare earths found in Ukraine could be found in China as well. So I think what US is trying to do is to sort of, they know that US will restrict the export, so they are trying to turn towards alternative. And therefore, they are really pressuring Ukraine into that rare earth deal. And most likely it will be signed. I think the cards are surely in the US favor. Ukraine surely need the US to end the war. So I think that will have some form of a limiting impact in terms of US front. So I think US foresee this problem and they are taking steps to mitigate it. Okay, next question. If investors move out of US assets, then where would they go? Chinese government is in no hurry to stimulate EU. Yes, so if they are moving out of US assets, actually we are seeing signs of strength in terms of the Eurozone bonds. Equities market-wise also slightly holding up better compared to the US. So I would say that apart from when they are moving out of the US, of course, we have seen gold as well, pushing on to record highs. So I think some of the inflows have been sort of spread out towards the Eurozone, towards some of the laggards, and also towards gold itself. But my view, of course, is that once once we get more clarity from the US front, we may see some of the flows back to the US, because I think US is still the attractive one in terms of being the front leader in terms of the tech space. It's just that near term, I think Trump wants to embark on this longer term restructuring of this economy, trying to bring back manufacturing supply chain, trying to bring down debt costs, so on and so forth. But once the restructuring has seen its end, much like what we have seen for China. So previously there was this worry that China is on this economic restructuring, but now we are getting more and more clarity, and therefore foreign investors are sort of shifting some capital back to China. Same thing for US, is a restructuring process. Once we get more clarity that potentially the tariff is done, and businesses will adjust to the new environment, and we should start to see some of the capitals flow back into the US. But of course, the timing is the crucial one, which nobody knows. Okay, let's see. A lot of questions in that sense. I'll try to tackle some of the more important ones. But otherwise, of course, you can bring those questions up on my weekly webinar as well, because I'm really running short of time here. Okay, as Trump wants to bring down oil prices, does this include palm oil prices as well? Nope, I don't think that includes palm oil. I think palm oil is a different dynamics from crude oil, because US is actually one of the largest producer for crude oil. But in terms of palm oil, I think they don't have much control over it. It's mainly spread out across some of the Southeast Asian countries being the major producer. So I think when you say to bring down oil prices, it really means bringing down the crude oil prices in that sense. Let's see. Silver, I talked about that. Yeah, so question on silver lagging behind gold upside. What's the possibility of catching up? Likewise, I think, as I mentioned, safe haven, people will still look at gold. Silver, there's still some economic sensitivity to that. So when global growth is slowing, silver may continue to lag behind gold prices. Okay, last question here. Do you expect Fed to restart QE soon due to treasury selling pressure and option weak demand? I think Fed will likely take on a more wait and see I think they wouldn't be too quick to restart QE, potentially until Treasury yields hit a new high in that sense. Otherwise, I think that is going to send a panic signal to the market. I don't think they will want that. And I think they wouldn't want to rush into it, given that some of the impact around tariff is still hard to say. So I think the tone here is that many people are still expecting a recession. Whether we have a recession or not, I think we have a chance that we may avert a recession. It's more of like, but growth will slow down dramatically, potentially to the single digit. Um, so I think it's really more of a wait and see here, and I don't think they will actually want to act so soon until Trump has sort of locked down some of the tariff posture in that sense. Okay. Yeah. I think there's still many questions, but I think I'm running out of time. I gotta go for my dinner. So but do feel free to sort of ask these questions in the next webinar. Every Wednesday I will have the weekly market scoop if there's no guest speaker. But of course next week we have Kwan Hao as the guest speaker. But thereafter, it will be me. And I'm always happy to share my views with you, and really appreciate you tuning in today. And hopefully markets will be kinder to us. And yeah, so how do we connect? Um, I'll ask the team to send out a EDM for next week's webinar, so that you can tune in and hear from Kwan Hao himself on where US market is going. And yeah, so I'll ask my team to send an EDM. So do feel free, don't put it in the spam mail, spam email. Yeah, so that's all for me. Okay, so thank you very much, everyone. Do have a good dinner, and I will see you next week.